Meaning they're buying less stuff.
They're buying less stuff. We've seen 7 consecutive quarters of both dollars and units declining. So you're buying less apparel, less items for your home, fewer toys. You're seeing some of the pressure in those categories.
Hey everybody, thank you so much for checking the channel out today. My name is Agabus, and we are so close to hitting 100 subscribers. I just want to say thank you for everybody checking the channel out here this last 2 months. Today we're getting some news from Target as well as from the Fed in the Dallas site that says things are starting to slow down. You heard it straight from Target CEO that they've had 7 consecutive quarters where things have been slowing down. Now the Federal Reserve Dallas is starting to say some of the same things from their service sector outlook. Let's take a quick look and see what they had to say. We're over here today at Zero Hedge, more like a train wreck than a soft landing, according to the Dallas Fed Service Sector Survey slumps in October. Growth in Texas service sector activity stalled in October, according to business executives responding to the Texas Service Sector Outlook Survey. The revenue index, a key measure of state service sector conditions, fell 8 points to 0.7 with the near zero reading, suggesting little change in activity from September. Here are some of the comments from this survey. All in all, it is not looking good. Overall activity is still stagnant due to overall economic conditions. Cash management has taken a whole new meaning. The economy seems to be steeply going down in the U.S. and major global regions. For engineering service, 2024 is supposed to be a recession year. Commercial real estate market seems frozen in some ways, and financing is hard to find. Restaurant businesses are suffering. Abnormal decrease in overall business activity. People are nervous about not spending their money. The geopolitical climate has increased uncertainty for the economy, and we are feeling the pain. Something must give with interest rates and tightening capital access, and people are feeling stuck when it comes to not buying cars, houses, appliances, etc. Now, I am not here to tell you what I think is going to happen. I've got no crystal ball. I'm just reading the news, and it looks as if things are really starting to fall apart here. It seems to be only a matter of time until something big might break. Would love to know your comments in the comment section below. If you had that crystal ball, please tell me when you think something's going to break. Over here at Yahoo Finance, the U.S. is still not out of the woods yet for a recession, according to the strategists. The stock market has seen a 3-month losing streak in the S&P 500, shedding 8.8% within that time. Alongside economic headwinds and a pending Federal Reserve decision, which happened yesterday, investors are unsure where to look for potential new investments. We still have a tightening mechanism, lower liquidity, higher volatility, and while we have been on the camp that parts of the economy are already in recovery mode, we expect that we are still going to see significant amount of potential risk on the market. Therefore, as you described, we continue to emphasize quality, both on equities and on fixed income. And over here at CNBC, Double Lines Gundlach says interest rates are going to have to fall as a recession arrives in early 2024. Double Lines CEO Jeffrey believes interest rates are about to trend lower as the economy deteriorates further and tips into a recession next year. He says, I do think rates are going to fall as we move into a recession in the first part of next year. The Federal Reserve's rate-setting committee met yesterday to keep and hold rates as they were. This is the second consecutive meeting that the central bank chose to keep rates static. The so-called bond king pointed to a few signs of an economic slowdown. Firstly, the unemployment rate, while still low, has been trending higher. Secondly, the key spread between the 2-year and the 10-year Treasury yield has stayed inverted for more than a year and has recently started to steepen, which is a recession signal, he said. And he also saw an initial wave of layoffs. His comments are he really believes that layoffs are coming, and we're seeing hiring freezes, and now we're starting to see layoff announcements as well. And lastly, we'll focus on, he also sounded an alarm over the growing federal deficit, which we have covered day in and day out on this channel. which ballooned to nearly 1.7 trillion at the end of the latest fiscal year that ended in September. And the budget shortfall adds to the staggering U.S. debt total, which now stands almost at 34 trillion. And if memory serves me, we just hit 33 trillion like a couple weeks ago. Billionaire Stanley Druckenmiller also is echoing a similar concern with the government spending. Boy, things are not looking so good here. If we look just at these articles, it looks as if 2024 is going to be a rough year. So everybody get ready. And as always, stay inquisitive, ask questions, stay informed, and stay subscribed for more. Thank you so much for checking the channel out today. Looking forward to tomorrow.